I mean, what's really going on in the market? Hey, everybody, this is Eric Spotswood, Regional Manager with Prosperity Home Mortgage. It's been a while since we talked about the market, so I thought I'd bring you some facts to go along with all the fear that exists out there in the market today. I think that is the biggest struggle that we face today is the perception of where we are versus the reality. So one of the big things that came up recently was obviously Silicon Valley Bank and the issues that they ran into. A lot of people pointed to that to say, see, this is a great indication of what's to come in the market. The reality was it was a unique position where they were a little bit over leveraged and maybe some long term bonds that they'd lost money on. When clients came in for a rush of pulling the money out, it put them in a very difficult situation. So, what does that mean for the market today? Should there be a surge of other bank closures? The Fed stepped in and does a great job backing up other banks to make sure there isn't a wave of these closures that are happening on, to make sure that there's a stability that's happening in the market. One of the things that you may see, though, it could potentially impact the Fed's desire to continue to raise rates as aggressively as they've been raising them. So you may see that approach soften. You also may see banks maybe that were holding loans on their portfolio start to be a little bit more cautious with how much they want to hold on to and what types of programs or maybe the rates that they're offering out there. So not a major wave of changes that's happening in the market. It actually could be a long-term good sign for rates and where things are trending. A lot of people, even though rates are a little up right now, are still projecting rates overall in the back end of the year to decrease and be in a better position. So when you talk about people who are concerned about the market, though, you have a lot of people who are concerned that it's going to happen like it happened back in 2008. Well, again, statistically speaking, let's have a little bit of perspective around what happened in '08. We went into a heavy recession. But when you look at that, what happened around that? This is a great graph that shows actually three of the four times prior to that major recession happening in 2008, home prices actually appreciated in a down market. And in 1991, when it happened, they only depreciated by about 1.9%. So as you can see in the bar there in 2008, it is a gigantic anomaly that happened then. I say that to say a lot of people look at that because it's one of the more recent housing impacts, and they think that that is a common occurrence or something that they should hold out. I hear people saying all the time, I'll just wait for the bubble to burst. I'll wait for the bubble to burst. You're seeing people that are thinking '08 is happening again. But as you can see here, historically speaking, for over 40 years, that just has not been the case, even in down markets. So what happened in 2008 that really caused a dramatic drop was a huge wave of foreclosures. So again, let's talk statistically. How likely is it that we're going to see a massive wave of foreclosures that's going to have a similar impact to what we saw in 2008? Well, let's look at a couple of real big driving factors. One of them is inventory, simple supply and demand, like we learned back in school. If there's way too much supply and there's not enough demand, then values are going to go down. There's not enough supply, there's a lot of demand, values are going to go up. That's what happened in the last couple of years. There was no supply. You talk about months of inventory, which is basically how long would it take if no other listings came in the market and things were selling at their current speed before all the inventory was gone. A healthy market is somewhere around 3 to 6 months. The last couple of years, you might have had it around 1 month. So it was very, very low. What this graph shows you here is back in 2008, there was 12 months of inventory. It was very, very high. So you had a huge amount of supply and not enough demand to offset it. Where are we today? We're sitting at about 3 months, a very healthy, even on the lower side of what inventory you would expect out there. So completely different than what we saw in '08. Another key driver, if you look at foreclosures, is what about equity? Because if I'm sitting here and I need to get out of my house, because people don't really walk away from houses if you have equity, or if I'm in a different difficult situation, maybe I lost my job or I'm in a different place financially, and I have equity in my home, then I sell it and I walk away. I don't let it foreclose, which again is where the impact happens. What you can see here is back in '08, '09, it was the lowest time in recorded history for the amount of equity that people had in homes. So if you were in one of those difficult situations like we were in the market and I needed to get rid of my house, I didn't have the equity to do it. A lot of that was because of the huge amount of interest only loans that were used, around the loans that were at 100% loan to value that were being used. And again, you talk about the supply and demand. When there's a ton of inventory out there and I don't have equity and I need to get rid of my house, I can't really sell it off. Right now, even before this past year's hyper appreciation in property values, we're at an all-time high in equity in properties. So likely happening is if you have somebody who's in a difficult position, because that still happens in any market, they have the equity to be able to sell their home and get out of it, not causing a wave of foreclosures to happen, which would then impact the values as much as it did back in '08. So if you keep looking at that and keep going down the rabbit hole a little bit more, let's talk about mortgage lending because there were a lot of bad loans that went out there. I talk about the interest only loans that went on. This is the availability of mortgage credit over time. So the availability, the higher the bar, the easier it is to get a loan. So if you see back in the early 2000s, it was the easiest time in recorded history to get a loan. There were a lot of stated income, stated asset loans, no income, no asset loans, a lot of loans that really weren't very responsible and put people in a position that put them in a difficult position. As you can see now, since 2008, with all the rules and regulations that have gone in place, it is the most responsible lending environment that has existed. You can see even in the COVID years, it got there in 2020, and you see on the far right side of the graph, it got even tighter. So the qualification or the quality of borrowers that are out there in the pipeline right now is the best quality borrower that's ever existed historically. Again, coming off what happened in the early 2000s, which is a lot of really bad loans and put a lot of really big exposure out there. So if you have all those things, you kind of cascade them. In 2008, I have a lot of bad loans because I was too loose in the guidelines. I don't have any equity in my property, and there's a ton of inventory that existed out there. That's going to lead me to having a lot of foreclosures because I can't get out of my house. If I look at today's market, it's been in a very tight lending guideline for a long time since the crash, really responsible lending. There's not a lot of inventory out there. There's only a few months. So there's not a ton of supply to fight with the demand that's out there, and equity is at an all-time high. All those things are going to offset foreclosures. But you still hear people talking in the market about foreclosures and about them being on the rise. Well, let's just put that in a visual real quick. This is the foreclosures that have existed. You can see all the way back there, 20 years worth of data here on this chart, basically. But what you're hearing is foreclosures are on the rise. Foreclosures are up. Foreclosures year over year are up 167%. But again, if I take a step back, there was a memorandum to stop foreclosures during COVID. So are foreclosures now going to be higher than that? Of course they're going to be. As that memorandum, stopped, as the market is continuing to go, you do see foreclosures on the rise. But as you can see here in the numbers on the far right, compared to the numbers even in the middle of the graph, the numbers in the middle of that graph is like 2014, 2015. No one felt like we had a foreclosure problem at the time. We're not even a fraction of those numbers in the market today. So while you're hearing about it in the market, my personal opinion is that's a lot more clickbait than it is actual data. You can see the really tall bars over there on the far side. That was 2008. So comparatively speaking, these bars on the far right compared to those bars on the left could not be further apart. So if you don't have the massive wave of foreclosures, you don't see the massive drop in prices. So we're a lot more insulated to that, again, because of the equity that's in homes, because of the inventory that's out there, because of the responsible lending than where we were back in 2008, which is the complete other side of the fence. Now, the other thing that people continue to say is, what if I want to wait? I want to wait and see if maybe I'm going to have rates drop and see if that'll impact me in a better spot. I'll continue to rent. So the right decision for you is the one you sleep best at night with. I never want to talk anybody into anything, but I just want to put some numbers on paper so that you're aware of them. If you got a loan for $400,000 and say you were renting for a year, if you rented for a year at $3,000 a month, it would cost you $36,000. So even if rates went down a full percent on a $400,000 loan, you would save about $263 a month. Now, that's great, and I'm never going to argue with good savings, but the reality is you spent $36,000 in rent to save that $263 a month. For perspective, saving $263 a month, it would take you over 11 years to recoup the $36,000 that you spent in rent. Even if they dropped a full 2%, which no one is anticipating, if it dropped a full 2%, it would take you almost 6 years to break even from paying rent for that year. Now, each rent situation is a little different. Maybe say my rent's only $2,000 or $1,500 or it's $4,000. You can talk to me and my team. We'll run the numbers for you. But the thing I wanted to impress on you is just because rates have gone down and you do have a monthly savings, it doesn't necessarily still mean it's a good idea. You want to factor in the amount that it costs you to get there so that you know it's a really great deal. So again, a lot of the perception in the market is it's not a good time to buy because I don't like where rates are. The reality is the rent on or the interest rate on rent is 100%, so it may still be a great time to buy. So in recap, what's really going on? The reality is inventory is still low and it's helping to stabilize prices, which is a great thing for all of us, which is completely different than '08. Equity is an all-time high compared again to when we ran into the issues in '08, which is when it was at an all-time low. Foreclosures, while they are up from a point where there was a memorandum to stop them from happening, of course, they are still historically very, very low. And rates, while they are up from a year ago, it still may make sense for you to lock compared to paying rent for another year and needing to recoup that cost. So hopefully this helped to give you a little bit of perspective on what's going on in the market. If you need anything, reach out to me or my team. But the general phrase that I use when I think about this market is it's probably better than you think. I hope you're having a great day, everybody. Take care.